ant will carry a crumb into the colony without ever asking what's inside it. Most people do exactly the same thing with their index funds, and it costs them, on average, around $200,000 over a working life. Not from picking the wrong stocks, not from bad timing, from owning the wrong funds and never noticing. I'm going to show you the 3 index funds that belong in almost every long-term portfolio and the 7 that quietly drain it. By the end of this video, you will know exactly which is which, and you'll never carry another crumb you haven't inspected. Let's start somewhere uncomfortable. Most people who own index funds can't tell you what's inside them. They picked a few because a coworker mentioned them, or because the names sounded reasonable, or because their 401k offered them in a drop-down menu. And then, for years, sometimes decades, that money just sits there, untouched, unexamined. That's the crumb in the tunnel. So before we name the 3 you should own, let's get the definition right, because the financial industry has spent 40 years blurring it on purpose. An index fund is a single pool of money that holds every stock in a specific index, in the same proportion as that index. An S&P 500 index fund holds all 500 companies. A total stock market fund holds essentially every publicly traded American company. The fund manager doesn't choose. The fund manager mirrors. That's the whole job. Because nobody is picking winners, the fees are tiny. And because no human is making decisions, no human can be wrong. Simple. In theory. In practice, the industry has spent 40 years engineering products that look like index funds, market themselves like index funds, charge fees like managed funds, and underperform almost everything. Telling the real ones from the imposters is the first skill any index fund investor needs. So, 3 you almost certainly need. Then 7 you probably shouldn't own. Let's begin. The first one is the foundation, a total U.S. stock market fund. Not the S&P 500, the total market. The most common versions are Vanguard's VTI, iShares ITOT, or Schwab's SCHB. They all do the same thing. They own essentially every publicly traded American company, weighted by size. The S&P 500 holds the 500 biggest. The total market fund holds about 4,000. That extra exposure to mid-cap and small-cap companies is where a lot of historical outperformance has come from. In many periods, that's the engine. The expense ratio is around 3 or 0.04%. For every $10,000 invested, you pay $3 or $4 a year. Compare that to an actively managed fund charging 1%, and the gap compounds into something enormous. Think of it like this. A colony doesn't survive by sending one ant out for food. It sends thousands. Some find nothing. A few find a feast. You don't have to know in advance which ones. You just need to own the whole foraging line. The second is the one almost no American investor holds enough of. International developed markets. VXUS from Vanguard. VXUS from iShares. This is your exposure to Nestle, Toyota, Samsung, ASML, Novo Nordisk, Shell, world-class businesses outside the United States. And most American portfolios own essentially none of them. The reason this matters isn't patriotic. It's mathematical. Over the past 15 years, U.S. stocks have crushed international stocks, and that has convinced almost everyone international is dead money. But pull the chart back further, back 120 years, and you'll find decade after decade where international stocks dramatically outperformed the U.S. The 1970s, the 1980s, the early 2000s. The assumption that the U.S. will always lead is exactly the kind of recency bias that destroys portfolios when conditions shift. And right now, international developed markets trade at meaningfully cheaper valuations than the U.S. That's not a prediction. It's a starting price. And history says starting price matters more than almost anything else. One colony's tunnel might be richest today. The colony that survives long-term keeps tunnels in many directions. The third is bonds. Vanguard's BND, iShares AGG. A single fund that holds essentially every investment-grade bond in the United States. Treasuries, corporates, mortgage-backed securities. All of it. Bonds are boring. They won't double your money. They won't make dinner party stories. What they'll do is keep your portfolio standing when stocks fall 40% in a year. And they will eventually fall 40% in a year. Every colony keeps a winter reserve. Not because winter is exciting, because winter is certain. How much to hold depends on your age and your stomach. In your 20s, maybe 10 or 15%. In your 50s, meaningfully more. There's no perfect number. There's only the number that lets you stay invested through the bad years without panic selling at the bottom. That's the only metric that matters. That's it. That's the core. Free funds. Total U.S. market. International developed. Total bond market. With those three, you own essentially every publicly traded company and bond in the developed world, pay almost nothing in fees, and need almost no maintenance. Now let's talk about the 7 you should approach with skepticism, because this is where most portfolios go wrong. The first one is hiding in your 401k right now. It calls itself a growth fund or an equity fund. It charges somewhere between 0.5% and 1.5% a year. The marketing talks about professional management, careful research, market expertise. The data, documented across decades of academic studies, says about 90% of actively managed funds underperform their benchmark over a 20-year period. A 1% fee compounded over 30 years quietly eats roughly a quarter of your total ending balance. Not a quarter of your gains above average. A quarter of everything. If you would have had $2 million in a low-cost index fund, you have about $1.5 million in the managed version, with the same underlying performance. The $500,000 doesn't announce itself. It's extracted, crumb by crumb, percentage point by percentage point, for 30 years. The second is nuanced. Target date retirement funds. These actually have a legitimate purpose. They're dramatically better than the alternatives many people would otherwise choose. The problem isn't that they exist. It's that the typical glide path is more conservative than it should be for someone with a long horizon, and the fees inside many of them are higher than necessary. Simple rule. If the expense ratio is 0.15% or lower, and you genuinely don't want to think about your investments, fine. Keep it. If it's 0.5% or higher, you're paying 4 times too much for what is, underneath, a basket of index funds you could buy yourself for a quarter of the price. The third are leveraged ETFs. The ones that promise 2 times or 3 times the daily move of an index. They sound like an obvious way to amplify gains. They are an extraordinarily effective way to lose money over any period longer than a single day. The math is called volatility decay, but the practical result is this. A 2 times fund doesn't return 2 times what the index returns over a year. It typically returns much less. In a volatile market, it can return dramatically less. There are real periods where the underlying index ended positive and the leveraged fund ended deeply negative. These products were built for day traders. The marketing rarely says so. The fourth, thematic ETFs. The AI ETF. The clean energy ETF. The metaverse ETF. The cybersecurity ETF. Each one takes a hot narrative, wraps it in a fund, and charges meaningfully higher fees than the broad market. 2 problems. First, by the time a theme is popular enough to justify launching a fund around it, most of the easy gains have already been captured. The companies inside are usually trading at premium valuations because everyone else noticed too. Second, themes go in and out of favor unpredictably. The cannabis ETF was the future in 2019. It lost most of its value in the years after. The metaverse ETF launched at peak enthusiasm and has performed terribly. An ant doesn't sprint toward whatever the rest of the colony is sprinting toward. By the time you can see the line, the food at the front of it is gone. Fifth, single country emerging markets funds. The India-only fund. The Brazil-only fund. The China-only fund. Exposure to emerging markets is a legitimate idea. But the right way to get it is through a broad emerging markets fund that holds dozens of countries. A single country fund concentrates all your risk on one political system, one currency, one regulatory regime. Broad emerging markets spreads that risk and lets diversification do the work it's supposed to do. Sixth, high dividend, or dividend-focused index funds. I understand the appeal, especially for retirees. The idea of getting a steady check from your portfolio is psychologically warm. The pitch is built to feel safe. But focusing on dividends biases your portfolio toward older, slower-growing industries, utilities, consumer staples, and away from companies that reinvest their profits, which is often where the real long-term compounding lies. Over long periods, total return funds with no dividend bias have outperformed dividend-focused ones. If you want income, the better approach is to hold a broad total market fund and sell shares when you need cash. The tax treatment is generally better, and you're not constraining your portfolio for an emotional reason dressed up as a financial one. The seventh sounds flippant, but it isn't. Avoid any fund that is heavily marketed on television, in financial magazines, or by financial influencers. The funds with the biggest marketing budgets are not the funds with the best returns. They're the funds with the highest fees, because the fees are what fund the marketing. Funds that compete on low fees can't afford to advertise. They have no margin. Funds that compete on marketing have higher fees, because that's the only way the marketing budget exists. The visibility of a fund is itself a warning sign about its cost structure. So here's how to act on all of this. If you're starting from scratch, build the core around 3 funds. Total U.S. market. International developed. Total bond market. A reasonable starting allocation. 60% U.S., 25% international, 15% bonds. As you get older, bonds rise, equities fall proportionally. That's the whole equation. If you already have a portfolio, your homework is to look at every fund you own and ask 3 questions. 1. What's the expense ratio? If it's above 0.1%, what is it actually doing that justifies the extra cost? 2. What's actually inside this fund? Is it adding something new, or just duplicating exposure you already have somewhere else? 3. Was this fund sold to you on a theme, a trend, or a story rather than on long-term mathematical evidence? Anything that fails this honest review is a candidate for replacement with something broader and cheaper. The biggest mistake most index fund investors make is not picking the wrong fund. It's owning too many funds. 16 funds, 23 funds, funds in the 401k, funds in the IRA, funds in the taxable account. None of them chosen with reference to the others. Every fund overlaps. The portfolio ends up massively duplicating exposure to the same handful of U.S. large-cap technology stocks because every fund holds those stocks. The investor thinks they're diversified because they own many funds. They're actually concentrated because all those funds own the same companies. The right portfolio is almost always smaller and simpler than the one you currently have. 3 funds is enough for most people. 5 is sometimes appropriate. 10 is almost always too many. One more thing, and almost nobody talks about this. Where you hold these 3 funds matters almost as much as which 3 you own. Same fund, different account, dramatically different tax outcome. Over decades, the difference is real money. Inside a 401k or traditional IRA, money grows tax-deferred. That's the right place for your bond fund and anything that generates regular taxable interest, because those would otherwise create a tax bill every year. Inside a Roth, money grows tax-free forever. That's the right place for your highest expected return holdings. Usually your stock index funds. Every dollar of future growth, never taxed. Inside a regular taxable brokerage account, the right place for the most tax-efficient holdings, like a total market index fund, which generates very low taxable distributions by design. Putting the same 3 funds in the right account types adds roughly 0.25% a year to your real after-tax return. Over 30 years, that quietly compounds into tens of thousands of additional dollars. It costs you nothing to do this. It just requires being deliberate about which fund goes where. Most people get this wrong by accident. Now you know the right answer. 3 funds. Total market. International. Bonds. The willpower to hold those 3 and ignore the noise about everything else. That is the willpower that quietly separates the people who build wealth from the people who quietly transfer their wealth to fund managers. An ant doesn't carry every crumb it finds. It carries the right ones into the right chamber for the right season. Now you know which is which.